Okay, good morning, guys. Looking for the day ahead. Let's just talk Fed statement, then look at the day ahead. Of course, the Fed delivered their monetary policy statement last night, 7 p.m. And, well, it's hard to really describe it, but basically the statement was more dovish than the statement that was released 6 weeks ago when they raised rates, but you would probably say it wasn't quite as dovish as markets wanted. As Vass was coining the term yesterday, it was dovish-ish. So reactions-wise, a bit confusing, but basically the Eurodollar is still trading where it was when the statement, or just before the statement was released, around the 109 handle. We did get a move higher. We had a test off the top from earlier on in the session, and then it reversed, and we chopped around, and ultimately where we're trading now is basically unchanged. So how has the dollar reacted? Well, it hasn't, is the answer. And I'm just looking now, checking in on cable, and cable didn't move much off the news anyway, but cable's pretty much where it was pre-statement. So the dollar basically hasn't reacted. If you look at, the equity space, then this perhaps was the biggest mover. Although, bond market did push higher as well. Let me just check in. In fact, in the end, we'll talk about bonds in a sec. But here's the equity space. And of course, firstly, we had a pretty decent push higher into the European close. We took out that high point that we had on the 24th of Jan, back above 1900. We chopped around a bit. Then the statement got released, and this, in the end, to begin with, the market didn't quite know what to do with it. But then we kind of pushed lower, and actually that gathered a bit of momentum. And by the time we got to 8 o'clock, getting towards the close, we'd come off 1% actually. So in the end, quite a big move lower here for stocks. And this basically was that idea that whilst the statement was more dovish than December's, it wasn't as dovish as people wanted or people were hoping for. You're getting a little bounce now. This is nothing, it's not a disaster by any means. I think obviously we're recovering those losses as I speak. We're about halfway back, a bit more than halfway back, and 1900 is again in the targets. With regards to bonds, then yields pushed lower, certainly on the short end, and indeed on the 10-year end, and the Bund, in fact, had the bigger move. If you're comparing Bund and T-notes, actually in the end it was the Bund that showed more inclination to move higher, and we went up and made new highs for the session in the end as we went into the close. T-notes pushed higher as well, not as convincingly, and T-notes right now are good support on the pivot all morning, all throughout the Asian session, and actually this isn't too far off that just initial pop higher off the statement last night. So not too much, I would say the Fed will be well pleased with this. The Fed are always anxious about delivering a message and it being interpreted in a way that creates market volatility. That's the last thing they want. They want their communication channel to be effective, and the only measure they have of that is to see how markets behave after they've communicated. And I would say Yellen is probably pretty smug this morning. She sits back, reclines her leather chair, arms, hands interlocked behind her head, feet on the desk, feeling pretty good about herself because basically she steered markets through another, policy event. If we look at how the expectations have changed now with regards to rate hikes, so as I said, it was more dovish than last time. So probabilities have shifted in a dovish way. Before the statement, you basically had pretty even on a July hike. It was about 40%.
Japanese economy minister.
It was about 40% of no hike and a 40% of a hike in July. You can see that's been pushed out now. So September, in fact, we don't get beyond the 6-month mark here to actually whether it is September now, I'm actually not entirely sure, but it's certainly, we're not looking for a rate hike before until after the summer, let's put it that way. But if we have a look at what the statement said, and let me, we pieced through together, basically the main takeaways were on the dovish side. So when they were describing the risks to the outlook, in December they said the risks were balanced, and the main takeaway from the statement was, instead of describing the risks to the outlook as being balanced as they did last time, they replaced that with, we're closely monitoring global economic and financial developments and assessing their implications for the labour market and for the balance of risks to the outlook. So that was their kind of nod towards China and the risks that presents. They've downgraded, so consumer and business spending were downgraded from being described as solid in December to just moderate this time. But they did acknowledge an improvement in the labour market, where they said job gains have been seen as strong rather than job gains being ongoing, as they said in December. The inflation language was mixed. They acknowledged inflation compensation has declined further, but they said their survey-based measures were little changed on balance. So I think that was probably a hawkish surprise. Their view on inflation is unchanged, basically, despite the commodity complex dropping sharply at the start of 2016, but then the core inflation rate's gone above 2%, so that's why. So there was something in there for the doves, but probably not, well, as I said, the Fed, I think, pretty much nailed it. They've managed to steer us through a meeting, and markets are pretty much unchanged. So I think, look, let's look at equities now. I'm going to look on the daily chart, because we're past the Fed now, and actually the S&P, it sold off 1% yesterday, but look, it's bounced quite nicely here. One thing to note, why has it bounced? One thing to note, here's a stat for you. And yesterday was the first day in 10 sessions where the S&P has finished up in the opposite way to oil. So the S&P had a down day yesterday, thanks to the Fed. Oil had an up day, and oil lifted 2.7%. It's the first day in 10 that there hasn't been a positive correlation, and to that point, a strong positive correlation. So the Fed bucked the trend, but look, it's already back on track, because oil's flat around the top end of yesterday's movement, and now here's the S&P bouncing to get back onto its correlation. So look, I'd say the S&P, I'd say we're still on here for perhaps a push and a move above 1900. I think we are now, a little bit of a short-term wobble last night because it wasn't as dovish as many wanted, but look, it was dovish, so even though they left the door open officially to a March hike, I think you can absolutely forget about it. So I think markets can move on now past the Fed and start looking ahead. And I think ultimately China risk has dropped. I mean, it's still there for sure, but China risk has dropped. And the important thing is oil. It's, look, we've gone, what was the date today? 28th? It was the 20th of January that saw us hit that low at 27.55, and so we've gone quite a few days now without a new low, and actually we're a good 15+% above that low. So the longer oil stays above 30, the more calmness that'll bring to the equity market. And as long as we don't get any China flare-ups, well then I think equities can stabilize and push back higher, and the S&P can track back above 1900, perhaps as we go into the end of the week. And then it's all about next week, where the first week of each month, of course, carries all the main macro data. We'll get payrolls, a payrolls update, etc. We'll get all the manufacturing and services PMIs for the world. And so, we can get back to looking at those fundamentals. Let's talk about what happened overnight, and let's talk about earnings. We've got a lot of corporate news flow going on. Apple, of course, had their earnings guidance, and this thing, Eurodollar's just moved on the move here, so we're getting a little bit of movement on the Eurodollar space as I speak. But Guidance from Apple about quarter one of 2016 was very weak. Boeing got slammed yesterday off weak guidance, down 9% in the end. Deutsche reported a big loss this morning, but that was as expected. I think the standout report from last night was Facebook. Here's their chart looking at daily active users. That's above 1 billion now. That's daily active users above 1 billion. And they delivered their earnings, which was phenomenal. I mean, this really is, at the moment, looks to be the standout report of the whole season. What had been a concern for Facebook in terms of its valuation was the fact that we had been seeing a decline in revenue growth rate. So it's a deceleration of growth, except that's just been completely destroyed as this bar on the right-hand side here came in way above expectation, and suddenly we're back to increasing revenue growth rates. It dropped to about 40% revenue growth. We're back above 50, and they said it would have been above 60 if it hadn't been for the strong dollar. So this is Facebook really starting to dominate the mobile advertising space. Of course, they have Facebook. Of course, they've got Instagram. They've got WhatsApp. They've got Facebook Messenger. And they're beginning to really start to monetize Instagram, and the prospects of monetizing WhatsApp look encouraging given their track record, and their revenue growth from mobile has been extraordinary. And now 80% of their revenue is mobile advertising. So really, really, really impressive and strong numbers here. Facebook share price up double-digit % as a result. So this is a nice welcome boost. As I said, Apple had been disappointing. Boeing was shocking. So, good news. Let's have a look at the calendar, and I'll just go down whilst I'm talking about earnings. Let's just go down here because the earnings calendar today is absolutely ram-packed. Look at the number of companies reporting, not just in America, although it's got to be one of the biggest days of the whole season. You've got the ones in bold as stand out. You've got these tech companies after the close, Alibaba, Microsoft, Amazon, big guns, obviously. Ford and Eli Lilly will be before the opening bell. In Europe or UK, Diageo, Anglo America, this is going to be interesting. They've been one of the big victims of the commodity collapse, of course. Their share price is over 90% down from 2011 levels, if you can kind of imagine that, over 90% down. So anyway, we'll see how much pain they're seeing, and more importantly, what's the outlook going forwards. In Europe, H&M, Deutsche already reported, as I said, so big day for corporate news. And on top of that, in amongst the earnings, I'm sure you'll have seen headlines all over the papers this morning about the tech tax scandal after Google did a deal with the UK government earlier in the week, and it's just caused an outrage. And Tim Cook was in Ireland last week. Apple are expected to get their fingers burnt, but at the moment, the UK authorities are being blamed for not penalising them enough. So the tax scandal continues, and actually, don't underestimate where that could go. I mean, that really could flare up into a proper sort of diplomatic problem. So the tax scandal's rumbling on and picking up momentum. Right. Coming throughout the morning. We've already had some of these, and it's a bit of a mixed picture because ultimately, on the one hand, you've got year-on-year let's say, for example, in Saxony, year-on-year CPI 0.4%, which is above the December reading of 0.2%. But then on a month-on-month measure, we've got a minus 0.9% print instead of a 0 flat % print last time out in December. So a bit mixed. But let's talk about UK GDP, because this is coming in 43 minutes. We're expecting 0.5% on the quarter. Let's have a look at the chart. This basically will finish off a year where growth has been very stable, albeit at a couple of notches down from the year before. So we've had 0.4 for quarter one, 0.5 for quarter two, 0.4 for quarter three, and he'll be 0.5 for quarter four. This actually puts it at about trend growth. We are expecting, if anything, UK growth to pick up marginally in 2016, but we're expecting the year to finish as it began and as it was throughout the year. So this GDP data will come. I mean, this will be an interesting one for sterling. If I just bring in the sterling chart, sterling's been absolutely annihilated this year. Phenomenal move to the downside. Perhaps Brexit risk, certainly rate expectations getting pushed out more into the future from the Bank of England. This double catalyst has moved this currency lower. But the growth outlook and the economic outlook, if you just put aside for a minute those Brexit uncertainties, then actually the economic outlook remains pretty decent. So we'll see if sterling can get a lift here off the GDP data that's due at 9:30. Other data, we've got a batch of stuff coming out of the Eurozone at 10, but none of it major. So it's just some economic, business, industrial, services, consumer confidence numbers. These aren't headline numbers. They're not going to probably do much. And then in the US this afternoon, we've got the usual jobless claims. We've got durable goods orders. This will be the December reading. So these are key numbers when thinking about quarter four GDP for the US, which we're going to get reported tomorrow, or is it next week? US GDP tomorrow. Yeah, US GDP tomorrow. So this will be the kind of final major contributor to expectations for tomorrow's US GDP print. More housing data, pending home sales. We got decent numbers yesterday on the housing front. In terms of speakers, I'll scroll down. We've got Costa, we've got Nowotny, we've got Weidmann, but Weidmann probably the most interesting out of this lot, not until after the European close. Okay, so that's it for the roundup. Stocks are the S&P's banks. We've got over that little disappointment last night about the dovish-ishness of the statement. You see European stocks are trying to push and reclaim last night's losses as well. You've got oil hanging on to yesterday's gains, and this is the important thing. If I just zoom in on oil, I think, the key level for oil on the bounce here, we haven't reached it yet, is this mid-December low at 34.29. If we can break yesterday's high, which incidentally is the high from the 25th of January, if we can move up and test the 33 handle, well then, this rebound continues and the destination should be the 18th December low as the key barrier, and then we really will find out whether this trend wants to properly reverse or not, because we are still in a downtrend. So keep your eyes on oil again, certainly a key driver for all markets, and enjoy the session. Thanks.